talk about four things. One slide on reset and grow. Then we'll talk a bit more about earnings. So there you might want to make some notes. A lot of the business units will present their plans later. So I will just give you 2 or 3 key bullet points per business that may be worth keeping in mind. I'll give you our first official stab at cash generation. Now, it's an interesting topic. I told Leonard earlier that if you ask 50 actuaries about how much cash we made last year, you'll get 70 answers. It's like cash generation in life company is tricky. But we'll show you what we think our cash generation is at the moment, and that work continues. And then I'll make some statements towards the end about capital management. So in a lot of our meetings with investors, people ask us questions, and we answer them honestly. But I think it's also fair that we bring a lot of that together in one place, so we can just tell you guys some of the big picture thoughts we have around capital management. Okay, so one slide on reset and grow. When we spoke here, actually in this podium 3 years ago, we made 3 promises on a financial perspective. We said we'll target normalized headline earnings of 3.6 to 4 billion. The reality is, unless something really weird happens in the last quarter, we're not going to make that target. Okay, the external environment has ended up being even worse than we ever predicted with COVID. So there's no way of arguing that we made it. Now, me and Hilly agree that we probably got quite close if you add back just the COVID-19 impact. So it's not a bad swing at it over a difficult 3-year period. The one that is very green is cost efficiency. So the way we looked at that cost efficiency 3 years ago is we took our group controllable expenses of just under 10 billion and we put them in 3 broad buckets: distribution, sort of product and service, and then head office. And we modeled roughly what could we do in each of those line items. And we thought we could save 700 million pre-tax versus inflation, which would have been a 500 million rand saving in real terms. In the first 11 quarters of the 12 quarters, we saved 1.3 billion against inflation. Our cost base of 10 billion is almost unchanged over the last 3 years. It's amazing how in 3 years, you're basically building billion rand annual earnings run rate difference versus had we not done the cost savings. So, that's probably the biggest achievement we have had from a financial perspective. Also, what I'm quite liking is quarter by quarter, I'm not seeing any areas where you get these bounce backs where people have cut too deep. It's consistent quarter on quarter, very limited growth and quite stable. The one where I gave ourselves a yellow is non-life insurance. We said we're going to take non-life insurance from 200 million a year to 500 million a year. We will get to the 500, but when we said that, we didn't have Forbes in our plans. Okay, so if you take Forbes out, we're a bit shy of the 500 million. At the same time, in guard risk, you had business interruption claims. So it's like you swings and roundabouts. I gave it yellow because there's no doubt that our short-term insurance earnings potential has grown a lot over the last 2-3 years, particularly in guard risk. I said this at the interims, I'll say it again now. Guard risk has had a series of one-off events in the last 18 months. So I think people haven't really seen the true underlying potential of guard risk earnings for a while now. And I think you guys will be pleasantly surprised when they have a clean 6 months coming up. Then the one where I did give ourselves a clear red is on new initiatives. We always acknowledge that we were maybe over-investing in new initiatives, particularly at the same time. So we were making a very steep J-curve in 2017, 2018. And we thought we could reduce new initiative losses by 100 million, which I didn't think was such a massive target at the time. But in reality, our new initiative losses have actually increased a little bit over the last 3 years. Now, India has actually delivered to plan, which was by far the biggest factor. So India is a good story. But 3 years ago, we had 3 other businesses in there. We had the lending business, the joint venture with African Bank. We had Momentum Money, which is a little bit of I hate to call it a transactional banking play, but it's in that sort of field. And the other one is IO, our joint venture with MTN. So India did to plan, but the other 3 ones, for example, the lending one's been discontinued. So we thought by now we'll make a small profit out of those 3 smaller ones. And we're not. We're still making a loss on those 3 cumulative. So new initiatives, a bit of a red one. Okay, let's talk about earnings. So there is a range there. I told Hilly yesterday, he reminds me of Steve Jobs, that every time I show him a number, I'm saying it could be from 500 to 700. Then Hilly goes out of the office saying, hey, it's 700. It's very dangerous showing him a range. I think I'm going to have to just show him the lower number going forward. Okay, so he's a natural at setting stretch targets because he ignores everything below the high point of the range. Also, if you summarize it on the right-hand side, my split is a little bit different to Hilly's because I took the investments business, the annuity book, as life earnings. So I get 70% for life rather than 60, if you include the annuity book. Non-life is already 15, and the last 15 is really split between traditional asset management and health administration. I suppose the point of that split is, I would say we're a bit underweight asset management profits compared to some of our peers. And we're also very much a life insurance company at this stage. And even though we're going to be growing non-life insurance activities, I think if you put them both under the moniker of insurance, we're going to be increasingly be underwriting business. More and more of our earnings are going to be underwriting premised, which I think is a good thing. I think it's a rewarded risk still in this day and age. Okay, now there's something new stuff here as well. So like the interims, I always said, I always try and include something new, keep you guys interested. And what I've done here for the first time, we're actually showing you how we internally allocate our IFRS NAV by business unit. So on your own time, you can go and have a look. For example, here, we allocate 1.6 billion of capital to Momentum Investments and 4.5 to Momentum Life. Now, sometimes it's easy to allocate capital, like guard risk is a separate license. I can just pick up their balance sheet, their numbers. When it's divisions within a big business, there's quite a bit of judgment and debate of who is responsible for what capital. But this shows you largely the life license and then health, how we allocate it. Now, the nice thing about this is you can see the first half of our capital, the first 11 billion of our capital, earns a return in the high 20s. So our core life insurance businesses are extremely profitable and cash flush. Again, that shouldn't be a surprise, but it's nice to actually put it down into actual numbers here. The other thing you'll see later is the head office, the shareholder cluster, is treated as a separate cluster here. If I added that back here, the ROE would still be mid-20s. So even if we sort of made these profitable businesses pay for the head office fully, we'll still have a 25% ROE in sort of life insurance. Then we bring the two yellow ones, so the average returns. Now, I'll start with Africa. So 3.6 billion of capital, earning about 11-12% ROE at the moment. That's improved by selling out a lot of the loss-making, more troublesome businesses. But we still have some big businesses like, let's say, Botswana, that has, 600-700 million of capital earning high single-digit returns. So in some of these markets, we have really struggled to build economic profit businesses, even though they're sort of running along, making 50 million a year, 100 million a year. It's an interesting theme that we often debate internally, like which of these African countries are big enough to build a proper at-scale business, and which are the ones where you almost have to acknowledge extended periods of weak ROE and take a long-term view that eventually it will become bigger. Okay, so Africa is receiving quite a bit of attention. Non-life is also interesting in that, obviously the one thing depressing that ROE is we just spent 2 billion on Forbes. Now, all of you guys will acknowledge that one of the first things we talk about ROE is it tangible or total IFRS NAV, okay? And the reason we did this work is mainly to measure our own performance in terms of capital returns. So clearly we need to take into account that we paid something, even though a lot of it's goodwill. So this is like a fully, all the investments are treated as invested capital. And Forbes is a good business, but we did pay more than a 10 PE for the business. So the ROI for now is quite modest. The other one that is often not obvious to people is Guardrisk is a great business. It's probably the best franchise, sorry everybody else, it's probably the best franchise we have in our group in its own marketplace. But the ROE is below 20. It's sort of 15, 16, 17%. So Guardrisk is a good business, but there's a lot of capital optimization that I think can be done there. Remember they do two things for capital. One is they take underwriting risk, but they also solve other people's capital problems. So I don't want to get into too much detail, but one interesting one, for example, is what do we charge the clients in Guardrisk who need capital? Are we charging them enough? Are we solving their problem at our own cost? Those sort of things we need to think about in terms of ROE. And then the last two small ones here is shareholder portfolio, which, like I said, could have been maybe allocated somewhere else. And the last one's new initiatives. So we only have 800 million of capital invested in new initiatives, but that dilutes ROE by 3%. Okay. So it is interesting when you start investing in new initiatives, just how big the marginal delta can be in that J-curve phase at your group ROE. In fact, that brings me to this slide. We had a lot of debate internally. Should we keep the slide in or not? I was the only one who wanted to keep it in. And it's my presentation, so I kept it in. But this shows you cumulative ROE. So as we move from our highest return business to our lowest return businesses, you can see our first 5 billion of capital earns nearly 50%. Once we add the next 5, that gets diluted to 40, and then it gets diluted to 30, eventually gets diluted to sort of 16.5%, 17%, or whatever it is here. So the obvious question I had is why do you want to show the big negative effect of the tail here? And the answer is that to me, it's actually opportunity. I would much rather have these big core businesses pumping ROE and then have a small tail to deal with. Effectively just by moderating new initiative spending and fixing one or two obvious things like in Africa and so on, waiting AFI to grow to its targeted ROE. If I had a core business making 15%, I would be scratching my head here how to get to 20. Whereas with this picture, I think the 20, I agree with Hilly, the 20 is achievable because this is the ROEs and ROE targets with today's capital management plans. There's still additional work we're doing, which I'll talk on the last slide. So we have a few more things up our sleeve in terms of ROE. Earnings, I don't have anything up my sleeve. on capital, I have a bit. Okay, where to from here? So this is Hilly's slide. I'll briefly talk through each of these line items. Now, starting on Momentum Life, we're expecting about 5 to 10% earnings growth for that business unit. On Myriad, we're expecting closer to 15% per annum earnings growth. So we believe our current market share on Myriad and the current margins of Myriad, combined with the current size of the book, enables us to grow in-force premium quite strongly and underwriting profits quite strongly. I think it sounds like an obvious point to make, but I'll make it anyway. At our current level of new business, the book is still growing. People often ask, why didn't your sales grow? The reality is that if your book is of a certain size and your sales volumes are X, you can still keep growing at X until the book gets bigger, and Myriad's in that phase. Myriad also has very good experience in terms of premium uptake of escalations and increased benefits and so on. So if you think of what is the one ambitious plan in Momentum Life, it is really around Myriad. Okay, we're targeting good mid-teens growth in Myriad. Beyond that, Investo, which is our savings product range, we think earnings there will be sort of quite sideways, maybe up a little bit. It's quite different to Metropolitan Life, where we expect savings profits to decline. In other words, the gap between current products and old products is narrower in the affluent market than it is in the entry-level market. So Investo will probably grow a little bit in nominal terms over the next 3 years. And then we have the traditional book, which will be shrinking in sort of single digits over the next 3 years in terms of profitability. Okay. Then going to Momentum Investments, and Hilly stole some of my thunder on these. So Momentum Investments, we're expecting modest growth, but that business is becoming a much better business at the same time. So beyond modest earnings growth, we're expecting that business to have more competitive pricing and much better technology to build off on. So in 3 years from now, I wouldn't be asking the question so much in terms of earnings. I would be asking, have you actually got what you wanted in terms of the offering and the technology and the platform? We're in that phase where we need to reinvest a little bit more to make sure that we remain one of the leading players. Metropolitan Life, sort of decent clip on earnings, 5 to 10%. But again, funeral and risk is growing in double digits. In fact, close to 15, 20% in these projections. Savings profits, we're expecting to go backwards by 100 million. So that was the point that Hilly made, that savings profits are going to decline substantially. And the reality is that the new business we sell today, the charges to clients, is just chalk and cheese to what it used to be. Also, a lot of you will remember the whole statement of intent and the surrender penalties. That's all coming to full play now. So we're not really making any surrender profits anymore here. Then we get Momentum Corporate. Now, this is also interesting in that the actual earnings growth you're going to see is going to be massive because the current earnings have been pummeled by COVID. Okay, but if we add back the COVID losses, the earnings for corporate is about 450, 500. We're expecting quite modest growth there. And the reason is that what is the primary assumption of growth in this business? It is the growth in the risk book, which is a function of employment and salary growth and so on. So we're taking quite a conservative view on the in-force book growth within Momentum Corporate. The other one here is there is nearly a 20 billion rand annuity book. So we did a couple of big annuities over the years. Those profits are slowly shrinking until we find the next big annuity. And in our projections, we don't want to put in another big deal when we don't know of one. So I think the annuity profits will decline a little bit over the next 3 years unless we sign another mega deal somewhere. Okay, health. I think this will be a positive surprise for quite a few people. We're sort of expecting 5 to 10%. So we're expecting real earnings growth in health. And this is a very difficult market. And it suffers from some of the same employment assumptions and so on as we had on EB. This assumption shows that we believe we're going to retain GEMS, okay, for the 3-year period, which we feel quite comfortable on. It takes into account that we have won some business lately. Okay, so I think it shows that we actually think we're in quite a strong position to defend and grow a little bit our health book. Also, the business is comfortable that its efficiency ratios will remain same or better over the 3-year period. So in health, we're expecting quite good things, and that is obviously our share of earnings. So the actual health business is nearly double the size, before minority interests. Africa, we're also expecting okay growth, 5 to 10% per annum. There's a couple of different themes in here. So there are some real growth stories like Ghana. When I joined, Ghana was losing 50 million a year, and now 5 years later, it's making more than 50. So Ghana is growing linearly at quite a nice sort of slope. So we expect Ghana to continue generating good growth. We also think the Namibia profitability can be improved further. So Namibia has been receiving a lot of TLC over the last few years. There's been a lot of, I would call them almost like operational issues that have also made it difficult to really optimize profitability there. So I think Namibia will improve. On the other side, we do have 80% of the Lesotho market. So it's a bit hard to expect very rapid growth in that business. The other one is that we do have quite a few bank assurance contracts across Africa. And on those, you need to be careful what you assume in terms of profit share going forward. So we are allowing for the fact that we might make a little bit less on bank assurance going forward. Okay, then we get to the more exciting stuff. So non-life, we're expecting very good growth, 15 to 20%. That growth is actually both across Guard Risk and Momentum Insurance. Now, Guard Risk is a lot of just pure gaining of additional clients and underwriting exposure. There's two angles to it. The underwriting one, I think most people get it nowadays, that Guard Risk has been in the market for 20 years. They know the underwriters. They know the different market segments. They can sort of pick and choose a bit who they want to partner with, who they want to buy, who they want to share risk with. And so far, they've done it quite well. And we'll continue providing capital for them to do that. So we're happy with that part of the strategy. The other part that surprises me, well, I don't know, it doesn't surprise me anymore. Surprised me a few years ago. There's still very good demand for self-captive solutions from big corporates. You always think to yourself, why don't these guys do it themselves? But the reality is, Guard Risk does it well enough that I don't think it's worth the effort to try to do it themselves. I think it is a really good offering for the corporate segment. Then you got Momentum Insurance that Brunt will talk about a bit later. The earnings growth is really driven by two things. One is extracting the synergies, both revenue and expenses, from the merger of AFI and Momentum Short-Term Insurance. But there's also genuine growth expectations in that the business are complementary. So Momentum can bring technology and a more modern way of underwriting and thinking about the business. AFI can maybe bring a better product offering for the broker market. Maybe a slightly different client perception and so on. So we are expecting quite good growth in short-term insurance as well, the retail side. New initiatives, we're expecting a 500 million rand delta here. Now, India will account for about 350, 400 of that. So India is a big swing factor here. As Hilly said, we actually had planned to bring the CEO of the India business here, but because of the timing and the results in India, couldn't really do so. The other thing that you need to note is we're also assuming that the IO losses and multiply money losses will go basically to zero. So that's also assumed there. And the last one is shareholders. We're going to try to keep the head office expenses flat for the next 3 years. Yeah. Okay, and I get a range of 4.6 billion to 5 billion. So Hilly thinks it's 5 billion point estimate. I'm telling you, it's a bit of a range here. And you know what? Hilly has been moaning a bit that these growth rates are quite modest, but I think in the current environment to grow at 10-15% is no joke. So I think these are quite good numbers. Now, clearly, it also has an impact on our ROE projection. So I only have one slide here. I don't want to bore you by stepping through everything. But on your own time, you can look at some of these numbers here. I mean, a couple of things happens here. The green blocks, if you look very carefully, the average ROE declines a little bit by 1 or 2%. So we're assuming that some new business margin compression and typical actuarial assumptions is that if you made a positive variance of 170 this year and your model it's 150 next year, 150, so we have got the ROEs falling a little bit on the green block. Within the yellow blocks, both Africa and non-life are going from 11, 12 to 14, so they're moving up within the yellow block. The big one is new initiatives. It goes from being a drag on ROE, a big drag, to being a modest drag, sort of slightly below the average for the group. And we get to a ROE of 18 to 20%. But like I said, I'm also quite confident on the 20 because there's a few things on the NAV. Also, if you start looking carefully at the bottom, you will see that the African NAV, for example, is hardly growing. It's because we're busy with a project where by September, October this year, we would have extracted R1 billion of capital out of Africa through special dividends. We already extracted about $500 million to date as we speak here. So we're doing quite a big capital sweep of the Africa businesses to get them to be a bit more efficient. Whereas on non-life, as an example, we're thinking of recapturing quite a bit of the reinsurance we're currently utilizing. So that requires a bit of capital. So the NAVs will tell you also some story if you go think about it in terms of what we're planning. Okay, and then we get to this sort of consolidated view. The three bullets on the left are quite a nice summary. So two of them are similar to last time. So last time we said we'll improve new initiatives by 100 million. This time we're saying we're going to improve by 500 million. Okay, so particularly in India, we're getting much closer to that steep part of the J curve. Non-life profits we expect to grow by 300 million, again quite evenly between Godric and MSTI. And the last one that is, Hilly alluded to it, if you look at our life insurance projections, our savings profits are hardly growing. But our risk profits are growing substantially. So we're expecting 600 million more life underwriting profits in 3 years. As a percentage of profit, that means we're expecting, literally 30% growth in life insurance underwriting profits. Yeah, 30 to 40%. Okay. Now, I also had the privilege of doing the most technical presentation today. So now we warmed up on the numbers. Now we can go to the slightly more detailed stuff. As I mentioned, asking people for what is cash generation in a life company is an interesting exercise, but you will never get an answer. So you need to decide somewhere what is cash. We have taken a very puristic view of cash. It is the maximum dividend you can pay from company A to B and from B to C and ultimately to holdings. So I had quite a few of the finance guys, and I think Gerbe is here, for example. I asked the guys to go and say, okay, go and interrogate potential dividends from every business for the next 3 years. Because the dividends really take into account earnings projections, capital requirements, liquidity requirements, business as usual projects. So rather than having a nice formula across everything, it was a bit more bottoms up again, which we do in a lot of things, is we wanted to say, okay, what are the dividends you can pay? Okay, and then we model dividends that can be paid up to holdings. One very important part of that is internal capital targets. Basically, how much the business units feel they need to retain, just business as usual basis. Then we obviously have some specific capital investments that fall a bit outside of business as usual, like India. There was no point in asking India for dividends. We just basically modeled how much dividend goes to holdings and then money goes out to support India. And there's also 1 or 2 planned projects that we asked the business units to give us dividends without them, but we have subsequently approved all the way to board level some technology projects without a few $100 million. Those were deducted from the cash generation as well. I showed there it's critical, the internal capital targets. So the one thing we also did is we looked at the main business units, and the largest by far is Momentum Life. So we have totally reviewed our Momentum Metropolitan Life, the combined life business, our view of target capital there. Now, if you go back the last time we spoke, we said we're targeting SCR cover of 7 to 2.1 billion. Okay? That's been our official target for a couple of years. That basically tells you that we want to have SAM capital of 25 billion to 30 billion. You know, straightforward, but that's quite a wide range. At 25 to 30 billion is not very useful for modeling dividends and things. You know, so we had to dig a little bit deeper. And the first thing you do is you look at the quality and the nature of the capital. So if you look on the left-hand side of the slide, when you pick up our SAM returns, you'll see we've got 31 billion of capital. But in reality, half of that is future profits. Okay, it's the margins in your book. That could be converted to cash through reinsurance, but it's quite expensive. So we said, okay, let's ignore that. We can't pay out the VIF. The other thing that's interesting of the VIF, and this was to me the most interesting part of the recent modeling, it has a very nice correlation to required capital in that, let's say we grow our business a lot. The VIF grows, but the lapse risk grows. Let's say interest rates go up. You know, interest rate risk, you know, decreases, but so does the VIF decrease. So that VIF component of your available capital actually fluctuates very much with the required capital. So it's not distributable, but it's a very good hedge for your regulatory capital. Then you have a strategic and restricted capital. So the life company, it's a separate legal entity, so you can give a loan to, for example, Guardrisk. Guardrisk go do some premium financing, 300 million. But now we're not going to pull that financing from Guardrisk overnight to pay claims. You know, so some of that capital is quite locked in to support the group strategic initiatives across other business units. Okay, that block will also contain fixed assets. Okay, so half the capital is future profits, can't distribute. 5 billion of the capital is stuff that I can't really access because A, it's either not in liquid form, or accessing it will destroy another part of our group in terms of complications. It leaves you with 12 billion of what I call high quality liquid NAV. This is sort of using the, I don't know if you guys remember that ex-Prudential guy was the CFO of Old Mutual. And the one time he got so upset about asking about cash, he said, I'll bring you in the truck tomorrow. You know, so I don't know if we can, but we can probably bring 12 billion in an armored van here if needed be. Okay, so that's the high quality NAV. So once we determined what is the real NAV we have access to on any given day, we then did new modeling of saying if some of the volatility is absorbed by the VIF component and some of it's absorbed by the strategic component, what is the remaining volatility we're happy to take on the high quality NAV? And we came to a view that we would never want less than 8.5 billion of this high quality NAV on our books. Okay. The second thing we realized is because a lot of the volatility is absorbed by the VIF component, we can have quite a tight range of 2 billion around it. So we're saying it's 9.5 billion to 11.5 billion. That is our range of what I call high quality NAV. I think the guys call it something else in the actuarial team. Okay. Now, it also means when we model the dividends, any money, any good quality capital above the 11.5, we model as being distributed immediately out. You will see there's a small surplus right now, and obviously that will be topical in the next cycle of board meetings leading up to the year end, and we'll look at that. Okay, now, because this is a nominal rand value, and it's not all of your capital, it's a bit hard to, how does this compare to the previous 1.7 to 2.1? You know, there's not a formula answer between the two, but I would say that it equates to a slightly lower cover, maybe a cover of 1.6 to 2 versus 1.7 to 2.1. Okay. Okay, so once we had a good hard look at how do we model capital requirements going forward, that 11.5 billion also grows over time. So this is where the guys go wild and do very impressive modeling, and then they come with a good common sense answer anyway. That 11.5 billion will grow at about 300 to 500 million a year. So that is our best estimate at the moment of the upper end of the capital target migrating over time for the next 3 years. It also means we need to retain 300 to 500 million of earnings every year. Now, we're expecting earnings of about 3 billion rand a year from this life legal entity. You do simple maths, 3 billion less 500, you get to, 82%. So we estimate that in the life business, on average, we'll be able to distribute 80 to 90% of earnings to holdings. And that then being the cash generation estimate for the life business. The bullet point in the middle is also quite important. Our negative reserves are very small. In MetLife, it's like $1 billion. In Momentum Life, it's less than $3 billion. We have very little intangible assets that impact our earnings. Okay. Also, we have historically not used reinsurance to convert it to cash. So that's the other thing I told the guys, is that as Myriad grows and whatever, one day we might need to look at how do we become more active in converting earnings to cash. But for now, all the earnings are quite easily, or not easily, but are distributable with the cash available on the balance sheet, in the policy of the funds as well. Okay, so that's the big business. Then we get to the smaller businesses, and I think I will finish on time. So we took the remaining businesses. We have 140 legal entities in the group, and Momentum Metropolitan Life is one, but it accounts for like 80% of everything. Then we took those remaining businesses and we put them into 3 buckets. There's the mature, established businesses like health. Health actually has an official dividend policy to its board of paying out 80% of earnings. Okay, happy days. Then we have businesses like MSTI in the middle block. They're now profitable businesses as part of with Forbes, but they're still growing. They need to reinvest capital in terms of being able to recapture reinsurance. There, the payout ratio gets to be quite low quite quickly. Then, and this is one of the unfortunate realities of finance, businesses that make losses, you have to fund 100%. In fact, 110%, because quite often they're growing while they're losing money. So you need to cover the operating losses and the capital requirements as well. Okay. You combine all this, the cash generation of the remaining business are quite low, sort of between 0 and 30% over the next 3 years. Okay. So a very cash generative core business and quite modest cash generation outside of that. Now you bring it together, and I'm not going to repeat too many things here. We estimate that for the next 3 years, we'll average 50 to 60% cash generation to NHE. Okay. Now, if you look at our dividend policy, we pay out between 33 and 50% of normalized headline earnings. It means that between 17 and 10% of earnings that are in cash are not paid out. So there's about 500 million a year on average of cash in excess of the dividend that ends up coming to holdings. Now, I'm quite happy with that buffer because obviously the world doesn't always go like in the movies. So if there's another COVID wave, it might be nice to have some money to rebuild the balance sheet ratios and so on. I think once that buffer becomes more like $1 billion and stuff, we will have to go and revisit the dividend policy at some stage. But I think it will only happen once India becomes self-funding. So maybe that's for the next strategy day that we'll talk about the dividend policy. Okay, so we're giving you a bit of a stab now at some of these numbers. You're welcome to obviously send questions through, and the finance guys can maybe answer some of the more detailed questions if you're interested. Okay, and I'll just finish off. Like I say, this is the last slide, is really a bringing together the most common questions we get asked, and how do we answer them? Usually we answer them the same, Hilly, so that's good as well. Okay, the first point sounds obvious, but it's not. We will not hoard capital. When you're sitting on excess capital, you know how lucky it is to sit there and think, okay, let's just keep it for another 6 months, 12 months, maybe something happens. You never know. You might want to have a war chest in case you want to do some M&A. I think we have decided that the cost of holding cash is just so hideous that we will be very strict in terms of any capital above that 11.5 billion in the life business, and any capital sitting in holdings that is not needed in the next 12 months will be distributed. Okay, we're going to try and hold ourselves very strict not to hoard capital to dilute returns. I suppose there's two angles to it. Is if we ever need more capital than, let's say, 2 or 3 billion, we might need to, if it's for an acquisition of some type, and I can tell you now there's nothing going on, we might have to say, guys, because we didn't hold a war chest, we need to talk to you, which my view is always that shareholders will be willing to support you if it makes sense. The other side is obviously if earnings are very weak, we won't have much surplus capital to pay a dividend out of the balance sheet. So dividends will have to follow earnings quite carefully in this model as well. The second point also important is 3 years ago when we changed dividend policy, at the same time we also said no dividend, we'll do a buyback program. Now, some shareholders didn't quite like that, and to be honest, different shareholders have different views on dividends versus buybacks. And we sort of acknowledge the fact that we need to keep both types of shareholders satisfied with our capital management policy. So we're also making a firm statement that we will never suspend dividends to a buyback program. It will always be an and on top of normal ordinary dividends. Okay, when I say never, I mean obviously if the share price discount is 80 or 90 or something, who knows, but for now, under all normal scenarios, we will pay a dividend and do a buyback together. Then the third point, and I always invite people to give us feedback. The third point comes from shareholder feedback over the last year. You know, when our rating went down to 50% of EV, whatever, a couple of shareholders asked us, you know, what is your hurdle rates in terms of acquisitions versus buybacks and so on? And we always sort of looked at our own share price, but it wasn't a direct input into our cost of equity. You know, so again, in this audience, you guys will probably understand exactly what I'm talking about, but we're basically taking market implied cost of equity in ourselves into our hurdle rate framework continuously. You know, so the weaker our own share price becomes, the higher the hurdle does come for M&A, and more attractive buybacks, for example, become. You know, so you know, if you went back a couple of years, you would have think that any deal at 20%, 25%, you know, you'll look at doing it. But now we're saying that if our share price is implying a cost of equity of 30 because the market's collapsed, we might want to hold back and rather do buybacks than M&A. Then also the fourth point is quite important, is once you decide you have surplus capital, then you get into a long debate, how do you deploy it? So we have set up a slightly more formal policy of how we compare buybacks versus special dividends. And it's not just a price to EV rating, it also takes your ROEV forecasts and EV profits into account. I think that step is also useful, that it will speed up. You know, so once you decide that you have surplus capital, I think it becomes almost automatic immediately what the process would be. So maybe you save yourself one round of debate and everything else. Then the last point, it feels a bit out, but I also want to land the message is that the numbers we have shown today is really the work we've done to date. We're still busy with other work. And there's three things we're looking at the moment. The iterative risk margin is probably the biggest one. So it's been quite topical in the industry because some of our competitors have spoken about how beneficial it is to them. So we're busy doing that work. And our current estimate is that it will reduce our required capital by R1 billion or so. Okay. So again, we've been historically quite conservative in the way we calculate our capital. And the iterative risk margin is the next step that we're going to do. So that will help in terms of capital. And obviously the required capital, I'm talking about solvency capital. You know, if it's R1 billion lower, there's a ratio. It might be R1.5 billion less of capital. The other thing we're looking at is there are some business units where internal models would be much more reflective of reality than the current standard formula. You know, now we have parked that work for a while because we also felt that maybe the regulator had its hands full. We will slowly start picking up that work again. So that's a bit longer term than the iterative risk margin. But that could also result in quite good relief in terms of capital. And the last point is that we've done a lot of work, and Jack is here as well, in terms of reinsurance. So historically, we have not used reinsurance at all. Well, very minimal reinsurance to manage our capital position. And if we look at the overseas market and even some of the local competitors, you know, we need to examine whether we've been overly conservative by not, because sometimes the reinsurance has a real economic advantage. So we will investigate that a little bit more. Besides capital, it also has a liquidity issue. You know, so better use of reinsurance will also make it easier to convert profits into cash, you know, at any given time. Okay, so we'll continue doing that work. Okay, and that brings me to the end of my presentation.